in order to keep the system going, they can't let money supply decline. But they've let money supply decline, which tells me the plan is to tank the entire credit system. And that's how you will own nothing. The you'll be happy part, I don't know what they're going to put in the water or the air, but that's how you'll own nothing when credit collapses.
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it.
In a world where the stability of the banking system teeters on the brink, and governments scramble but fall short in their attempts to avert disaster, one asset emerges as a beacon of hope for those looking to protect their wealth from the ensuing chaos. Silver, a precious metal that has stood the test of time, now stands at the cusp of an unprecedented surge. Financial analyst Alisdair Macleod has broken down the alarming issues plaguing our financial systems and points to a startling conclusion. Silver's value could skyrocket to £3,000. Why silver, you ask? Stay tuned as we unravel the intricate web of economic turmoil, banking crises, and the silver lining that could save your wealth from disappearing into the abyss. Before we dive deeper, remember, this journey through the complex financial landscape could very well be your key to safeguarding your future. So hit that subscribe button and embark on this enlightening voyage with us.
Yeah, I mean, I think the sort of overall background to this is that people expect interest rates to diminish over time and bond yields to fall over time as well. So that, as far as most people are concerned, this is the point of maximum pain, but it's going to get better. And that is why the S&P is where it is. That is why the yield curve is sloping so negatively. And by that we mean that the 4-week US Treasury bills yield something like 5.4%. If you go out to the 10-year, that's yielding just over 4%. So that's the extent of the negative yield curve. The expectation is that these yields are not going to go up materially, which is why you get less of a yield on them than the short term. I think that's probably mistaken, and that if that swings back, as I expect, to reflect higher interest rates in time, then that's going to do an awful lot of damage to not only the banking system but to investors' portfolios. Put another way, I think everyone, the market consensus, I think, has got this entirely wrong. It assumes that on the basis of the last 10 years' experience, we can have low interest rates without inflation taking off again. And the hope is that we will return to that condition. Those of us that have been around a lot longer know that that's not the only situation which markets face. If you actually look at it more, if you like, sort of standing back and looking at things, the first thing to notice is that there is a huge budget deficit in the order of 3 trillion this year. That's my assessment, incidentally. It'll be roughly 3 trillion in this fiscal year to end September. Now, what we're talking about is an extra 3 trillion of credit, if you like, credit coming back into the GDP, hoisting up GDP. And that's why GDP looks so good. But what it will do is it will also push up prices. All that, all that extra currency just ends up pushing up prices. It's not a mechanical relationship, but nevertheless, that is what happens. So what we're going to see is yet more loss of purchasing power for this debauched currency to come. This is not over yet. And that being the case, then not only do we have the commercial banking system restricting credit and therefore driving up the cost of credit, as it were, in the sense of interest rates, but you're going to see that the Fed is completely powerless and has no option but to raise interest rates by the end of this year.
As we peel back the layers of this unfolding narrative, our focus sharpens on silver, a metal that until recently lingered in the shadows of its more illustrious counterparts. Yet it is silver that now captures the imagination of investors worldwide, sparked by its largest gain in months, a surge that has not only turned heads, but also ignited speculation of a potential super squeeze. This phenomenon isn't just a fleeting moment in the financial markets. It's a harbinger of a seismic shift in investment paradigms. David Scott, a seasoned market analyst, has been closely monitoring these movements, noting how silver's sudden leap has drawn parallels to the euphoric silver squeeze era of 2021. But what's driving this surge? It's a confluence of excitement on social media, coupled with the rallying of other low or no-yielding assets since late last week that's fueling this speculation. Silver, in its gleaming resilience, is not just another asset, it's becoming the focal point of an investment revolution. But here's where the plot thickens. While many are quick to compare silver's movements with the meteoric rise of digital assets like Bitcoin, Scott urges caution. The fundamentals that dictate silver's journey are vastly different, rooted not in the halving of supply or speculative fervor, but in the tangible demand from industrial and jewelry manufacturing. This isn't to say that the excitement is unwarranted. On the contrary, the fundamental tailwinds propelling silver forward are robust, fueled by the rising tide of U.S. market-based inflation expectations. Inflation, a specter that haunts economies, has seen its expectations surge, defying the Federal Reserve's mandate and challenging the traditional financial orthodoxy. As real U.S. yields teeter on the brink, the allure of silver grows stronger, its shine undimmed by the fluctuations of ephemeral market trends. Amidst this whirlwind of economic forces, silver's narrative is being rewritten. From the technical charts signaling bullish momentum to the strategic moves by savvy investors positioning themselves ahead of potential gains, the stage is set for a dramatic escalation. The question on everyone's lips: is this the beginning of the great bull market in precious metals? As we traverse this intricate landscape, we invite you, our discerning viewers, to ponder the potential of silver. In a world rife with uncertainty, could this be the asset that stands as a bastion against the tempest of economic upheaval? The journey is fraught with risk, but for those willing to navigate these tumultuous waters, the rewards could be monumental. And as we delve deeper into this saga, let us not forget the importance of informed decision-making. Your engagement is crucial to us, so we encourage you to share your thoughts and questions in the comments below. Could silver be the key to unlocking wealth preservation in these uncertain times? Join the conversation, subscribe for more insights, and together, let's uncover the mysteries of this financial enigma.
I think it's a very interesting question. I cannot imagine that the Fed has looked at the banks to which it has made this facility available and made an assessment as to whether they can actually end this or not. The fact that they have said that they're ending this in March, I think indicates that they don't see any trouble ending it. I mean, I'm sure it's going to hurt a few banks, yes, but not to the point where it threatens their solvency. So I would take that as actually a very, very positive thing. But of course, that was before we saw the New York Community Bank problem. I mean, presumably they're not in the, I don't know. I mean, they may be in that lending scheme. I must admit, I did expect this scheme to be extended. So in a sense, I'm a little surprised that it hasn't been suspended. But I take it as an indication that the Fed has looked at these banks, the banks that have participated in the scheme, and reckoned that it's okay. So. So we just hope, I think.
In the wake of silver's meteoric rise, it's pivotal to distinguish its journey from that of its digital and metallic peers. Silver, often overshadowed by the luster of gold and the digital dazzle of Bitcoin, finds its unique allure not just in its inherent value, but in the intricate dance of supply and demand dynamics that underpin its market. Silver's narrative diverges sharply from Bitcoin, a digital enigma that captivates the modern investor's imagination. While Bitcoin rides the waves of technological innovation and speculative fervor, silver's story is firmly rooted in the tangible world. Its value isn't derived from the cryptographic puzzles of the digital realm, but from its indispensable role in industries ranging from renewable energy to healthcare, alongside its storied presence in jewelry and as a historical store of value. The comparison with gold, while inevitable, reveals silver's unique position in the precious metals hierarchy. Gold's rally often captures headlines as a barometer of investor sentiment during times of economic uncertainty, yet silver's utility extends beyond its safe haven appeal. The industrial demand for silver, driven by its exceptional conductivity and antimicrobial properties, sets it apart, anchoring its value in the physical world's needs and innovations. This isn't to say that silver's rise is devoid of speculative interest. Like any asset, it's subject to the ebb and flow of investor sentiment, influenced by macroeconomic indicators and market trends. However, the fundamental tailwinds supporting silver's value proposition are robust. Inflationary pressures and declining real yields have historically propelled investors towards precious metals as stores of value. Silver benefits from this shift, its dual role as an investment and industrial commodity amplifying its appeal. Moreover, as we delve into the specifics of supply and demand, the nuances of silver's market dynamics come to the fore. Unlike Bitcoin, where supply is algorithmically capped, and gold, which sees relatively stable production levels, silver's supply chain is intricately linked to its industrial use. This relationship introduces a layer of complexity to its market, where shifts in industrial demand can significantly impact supply levels, adding another dimension to its investment thesis. In this broader economic and financial narrative, silver stands out not just for its recent price performance, but for the underlying factors driving its demand. The transition to green technologies, particularly solar energy, underscores silver's critical role in the global push towards sustainability. As nations and industries invest in renewable energy infrastructure, silver's industrial demand is poised to grow, further entwining its market dynamics with the broader themes of innovation and sustainability. Thus, as we chart the course of silver's ascent, it's essential to view it through a multifaceted lens. The excitement surrounding its market movements should be tempered with an understanding of the deeper currents shaping its trajectory. Silver's story is not just one of financial speculation, but of a commodity whose value is deeply interwoven with technological progress, economic policies, and the timeless allure of precious metals.
So I think we've got the FOMC meeting that's going to play out a little after this is recorded. And the market hopes that there will be a slightly softer tone. You've seen the yield on the US Treasuries ease off in the last few days ahead of this meeting, which tells me that the word on the street is that, this is going to be slightly softer, etc. But that's not actually what this is about. This is about liquidity going away from the people who really need banking facilities towards the US government. Why is it that they seem to be funding themselves so easily? Well, the answer is it's all being done in the T-bill market. The banks and the money funds are basically putting everything, all their liquidity, into the T-bill market. Why do they do that? Because the regulators tell them that this is a risk-free option. They're getting out of risk. That's all this is about. So the banking problem, I think, is a global problem. It embraces not just the American banking system, but also the Euro system, Japan. And Japan has been trying to sit on bond yields because it knows that if bond yields rise, not only does that make the situation as far as the Bank of Japan is concerned really frightening, but also Japanese banks are very highly leveraged. They've got asset to equity ratios in the region of 20 times. That is staggering. You don't normally get, at the top of the lending cycle, you don't normally get it that extreme. And so, it got there basically because negative interest rates basically compress the margins. And the only way you protect the bottom line as a banker is you leverage up your balance sheet. That's what they've done. And now, we're going to pay the cost. And I think that this, sort of New York Community Bank Corp is a bit of a canary in the gold mine. In the banking industry. So that, I think, we could be about to embark on another round of concerns about the banking system. And I think it is global. So that's going to start filling the head.
As we delve deeper into the intricate tale of silver's ascendancy, it becomes increasingly clear that the underlying economic winds are propelling this precious metal towards uncharted territories. This segment of our journey illuminates the macroeconomic indicators and fiscal phenomena that have not only catalyzed silver's recent surge, but have also solidified its standing as a harbinger of economic foresight. In a world rife with economic uncertainties, inflation has emerged as a formidable specter, haunting both households and markets alike. The narrative, however, takes an intriguing twist when we consider the role of inflation in silver's meteoric rise. Market-based inflation expectations in the United States have witnessed a dramatic surge, transcending the Federal Reserve's 2% mandate to reach nearly 3%. This seismic shift is not merely a statistical anomaly, It is a potent signal of the growing investor apprehension about the purchasing power of fiat currencies in the face of unchecked monetary expansion. But why does this matter for silver? The answer lies in the metal's historical role as a store of value. In times of rising inflation, savvy investors instinctively seek refuge in assets that have stood the test of time as hedges against currency devaluation. Silver, with its dual allure as both an industrial commodity and a precious metal, emerges as a compelling sanctuary in this turbulent economic climate. Yet the plot thickens as we explore the realm of real yields, the relationship between real yields, essentially the yield on bonds adjusted for expected inflation, and precious metals like silver is intricate. As real yields diminish, the opportunity cost of holding non-yielding assets such as silver decreases, thereby enhancing its appeal to investors. This dynamic, set against the backdrop of a declining real yield environment, further elevates silver's status as a prudent investment choice in the current economic landscape. Fiscal policy, too, plays a pivotal role in this saga. The United States, navigating through the largest budget deficits outside of crisis periods in modern history, finds itself at a fiscal crossroads. With the specter of the Great Depression, the Great Recession, and the recent pandemic as historical precedents, the fiscal landscape appears daunting. The implications for silver, however, are profound. As the government grapples with ballooning deficits and the prospect of continued monetary expansion, investors are increasingly drawn to the tangible security offered by silver. The convergence of rising inflation expectations, diminishing real yields, and expansive fiscal policies creates a perfect storm for silver. As traditional financial instruments and fiat currencies appear increasingly vulnerable in this environment, silver stands out as a bastion of stability and resilience. Its allure is magnified not just by its intrinsic value, but by its potential to act as a hedge against the fiscal and monetary challenges that loom on the horizon. In this chapter of our exploration, we've uncovered the economic undercurrents that bolster silver's ascent. As we venture forth, remember that the journey through the world of investment is fraught with complexities and uncertainties. Silver, in this context, represents not just an asset, but a symbol of enduring value in an ever-changing economic landscape. Let's continue to navigate these waters together, armed with the insights and understanding that will guide us towards informed decisions in the pursuit of financial security.
And this goes to the heart of the importance of property rights. I understand, and this is what I've read, that there was a situation in California where the feds, sort of, if you like, went into a bank's vaults, whether it was a bank or whatever, I'm not too sure, and confiscated all the property in it. If that is true, that is absolutely appalling. And the point behind the question is that it is not secure to put your gold, your silver, into a safe deposit box because the feds can open it. Now, in this country, we have very strong property rights, but if the police get a court order to open your box, then they can get a court order. So they just have to go through that administrative hoop. Now, admittedly, they do have to convince a magistrate or a judge to issue the court order. But having said that, they're in a very strong position to persuade a magistrate or a judge to do so. And of course, this is why James Turk set up gold money, because he saw that this was a problem. And, when things really cut up rough on the monetary side, on the currency side, then, people are going to be very, very concerned that there might be a confiscation of gold and silver. And under those circumstances, a safe deposit box in private safe deposit box, could well be raided. So this is why James set up gold money, and it gives the facility for anyone to save or store their gold and silver on a custodial basis in a foreign country. Switzerland is a very good question. I would say that Switzerland is generally safe. But having said that, there have been too many examples of the Swiss taking a pragmatic view when it comes to the relationship with US citizens. I think probably a better alternative, or, well, sort of maybe spread it around a bit, perhaps go to Singapore, look at Singapore, because they haven't, they don't basically buy into, what we're doing. It's turned out to be really quite a secure place. It's based on English law. When the European Union started, and the OECD started, bringing in rules which made it very, very hard for anyone using an offshore centre to retain their privacy. Singapore didn't go along with it. They retained their privacy. So that's, there are faults there. The other thing I would say for American citizens, be careful that you don't pick a vault storer which is owned by an American company, because there could be an executive order which forces American companies to, divulge any gold or silver, any metal that they actually hold on behalf of U.S. citizens. So that's another aspect which I would take into account.
In the unfolding narrative of silver's ascent, a crucial chapter is dedicated to the broader fiscal landscape that has been instrumental in guiding the metal's trajectory. This exploration takes us beyond mere market dynamics, venturing into the realm of fiscal policy and its profound implications on investment strategies, particularly in the context of silver's burgeoning appeal. The United States stands at a fiscal crossroads, marked by a historic level of budget deficit not seen outside of periods of acute crisis. This deficit, eclipsed only by the financial exigencies of the Great Depression, the Great Recession, and the recent pandemic, casts a long shadow over the economic landscape. The magnitude of this fiscal imbalance, coupled with the political stalemate suggested by the latest polls, paints a picture of a nation grappling with its economic destiny. The inertia in Congress and the prospect of continued gridlock do little to assuage concerns about the trajectory of budget deficits and interest outlays. Yet, it is within this fiscal quagmire that silver's luster becomes even more pronounced. The reasons are multifaceted. Firstly, the fiscal situation acts as a bellwether for the broader economic health, signaling potential inflationary pressures that could erode the purchasing power of fiat currencies. In such an environment, precious metals like silver, with their inherent value and historical role as stores of wealth, become increasingly attractive to investors seeking to hedge against inflation. Moreover, the fiscal challenges facing the United States underscore the importance of tangible assets in a portfolio. As the government contends with the specter of ballooning deficits, the potential for increased monetary expansion looms large. This scenario, characterized by the printing of money and subsequent inflationary pressures, augments the appeal of silver. Unlike fiat currencies, whose value can be diluted through monetary expansion, silver's intrinsic worth offers a bulwark against the devaluation of paper money. This juncture in our journey also compels us to consider the global implications of the U.S. fiscal situation. As the world's largest economy grapples with its fiscal dilemmas, the ripple effects are felt across global markets. The uncertainty surrounding fiscal policies and their impact on currency values further bolsters the case for investing in silver. As investors worldwide seek refuge from the volatility and unpredictability of fiat currencies, silver emerges as a haven of stability and security. In this landscape of fiscal uncertainty and economic challenges, silver's allure is magnified not merely by its physical properties, but by its capacity to serve as a hedge against fiscal irresponsibility and monetary expansion. As we traverse this complex terrain, it becomes increasingly evident that silver's role in an investment portfolio transcends conventional wisdom. It represents a prudent response to the fiscal and economic turbulence that characterizes the current era. As we conclude this chapter of our exploration, it's clear that the fiscal landscape is a critical piece of the puzzle in understanding silver's ascent. In a world beset by fiscal deficits and economic uncertainties, silver stands as a testament to the enduring value of tangible assets in safeguarding wealth. The journey through the intricacies of fiscal policies and their implications for precious metals investment has illuminated the path for those seeking stability in turbulent times.
Yeah, the problem with the banking system really is it starts almost from the central banks downwards, because, as I've said on your show before, the central banks are deeply into negative equity. If they had to behave like the rest of us, there would be the directors would be in jail by now. But these are government organisations, so they get away with it. But we've had this morning, and this is Wednesday the 31st. We've had news that the New York Community Bancorp shares have collapsed is too strong a word, I suppose. At one stage, they've down about 40%. Hitting new lows. This is not really good news. This is telling us the market is effectively having a run on the bank, if you like. So I suppose that this is all going to come back into the headlines in the next few days. It might help gold, but I'm going to put that to one side for the moment. We'll talk about that later. The problem with the banking system is that when banks basically are overstretched and trying to reduce the risks that they face, then things start going wrong. And I'll give you another example. We've had the Evergrande collapse in the Hong Kong courts, where it was ruled that the proposed reconstruction wasn't going to work and so on. As I understand it, the value of Hong Kong property has taken a bit of a dive on it. Now, this makes one wonder. I mean, I'm sitting in the UK. We've got two banks in the UK which are very heavily involved in Hong Kong. Hong Kong Shanghai Bank, obviously, which now calls itself HSBC, and Standard Chartered. I mean, these are two banks very, very busy in the Far East and particularly in Hong Kong. So I would not be surprised to see that questions will be asked about their solvency and so on. So that's likely to begin to impact the banking sector in the UK. I think there's nothing really specific. I mean, when you get New York Community Bancorp getting into trouble, I mean, we're not talking a major bank or anything like that. I have no idea what the size of the balance sheet is, but I don't think really it's all that important. But I think it's just the indication that this problem has not gone away. And furthermore, the interest rate outlook, I think, is being driven as much as anything by the tightness of bank credit. Why is bank credit tight? Well, bank credit's tight because banks don't want to lend money to businesses because they see business conditions at very, very best stagnant, and at worst, I mean, particularly up and down the country, small and medium-sized businesses are struggling and they need cash flow replacement, and they go to the banks in order to have an overdraft. And the banks are basically saying either no, or if they do offer overdraft facilities, it's with goodness knows how much extra collateral and all the rest of it, like directors' houses and so on, that they have to put up for collateral. And on top of that, the rate is high. So this idea that interest rates are falling, forget it. When you get a shortage of credit, the rates actually rise. And I don't see anyone actually fully understanding this in all the commentary that I read on the internet and here on YouTube and the radio.
As we navigate further into the labyrinth of silver's ascension, we arrive at a crucial juncture: the analysis of technical charts and market sentiment. This chapter delves into the realm of technical analysis, a discipline that, while grounded in historical price data and chart patterns, offers a window into the psychology of the market and potential future movements of silver prices. The story of silver's recent journey is etched in the fluctuations and patterns observed on its charts. Market analysts, with their keen eyes trained on these graphical representations, have witnessed a series of bullish signals that suggest a continuation of silver's upward trajectory. The dragonfly doji candlestick pattern, a rare occurrence marked by a long lower shadow and a close near the open, recently made its appearance. This pattern is often interpreted as a signal of a potential reversal in downward momentum, indicating strong buying pressure and a shift in sentiment from bearish to bullish. Silver's resilience is further underscored by its repeated bounces from key support levels, notably around the $22 mark. This steadfastness in the face of potential downturns speaks volumes about investor confidence and the underlying demand for the metal. The breach of resistance at $23.50, previously a formidable barrier, marks a significant victory for bulls in the ongoing tug-of-war with bears. Looking ahead, Technical analysts are setting their sights on the next critical resistance level, $24.42, a threshold that has previously repelled silver's advances. The importance of this level cannot be overstated. A decisive break above could open the doors to further gains, challenging past resistance zones and potentially setting new targets for bullish investors. However, the path forward is not devoid of challenges. Even as silver's price momentum gathers strength, the technical landscape reminds us of the inherent risks and rewards associated with trading and investing in precious metals. The narrow corridor between current levels and looming resistance points highlights the delicate balance of risk and reward that traders must navigate. In this context, the concept of risk management emerges as a vital component of any investment strategy. As silver's journey unfolds, the prudent investor is reminded of the importance of setting stop-loss orders, a tool that can protect against unforeseen market reversals. The decision to enter the market now, wait for a pullback for a more favorable entry point, or wait for a breakout above resistance levels encapsulates the strategic dilemmas facing those looking to capitalize on silver's momentum. This exploration of technical analysis and market sentiment offers a glimpse into the complex dynamics at play in the silver market. As we ponder silver's future, we're reminded that its story is not just one of numbers and charts, but of human psychology, market dynamics, and the perpetual quest for value in a fluctuating world. In our journey through the world of silver investing, this chapter on technical analysis serves as a testament to the importance of vigilance, strategy, and an understanding of market signals. As we continue to chart the course of silver's ascent, let us remain attuned to the lessons of the past and the possibilities of the future, ever mindful of the balance between risk and reward.
But I tell you what, I put together a chart, which I think you've got a copy of. Basically, what I did was I put together 7 tech stocks, and there's, if you like, the monikers are down there on the bottom in the tech index. And I rebased it to 100 on the 24th of February 2020, which roughly is when the bull market, this current bull market phase started, both for these tech stocks and also for Bitcoin. Now, Bitcoin is a red line, and you can see that up until, I think it was about October 21, there was a bull market in both. The correlation was perhaps not all that tight, but you can see that underlying bull market. And guess what? They turned at exactly the same time and then started going lower with a reasonably high level of correlation. The bear phase then ended, and it then turned round a year and a bit later. I think it was October the 22nd, that second dotted line. And then we go into a new bull phase, and the correlation is there. And if you look at the correlation in the last few months, I mean, it's very, very tight. So what does that tell us? It tells us that Bitcoin is behaving like a tech stock. And what's been driving tech stocks? Well, tech stocks are in a bubble. I mean, I would contend they're in a bubble. And if you get higher interest rates, as I've just described, then tech stocks are going to crash. It's as simple as that. So where does that leave Bitcoin? Does it leave Bitcoin with this sort of wonderful idea that, because the dollar's going down and it's being printed in ever greater quantities, that, it's going to go to 1 million or whatever? I mean, this is what the hodlers tell us. No, it's a tech stock, for goodness sake. It's mirroring the bubble in the tech stocks. So when the tech stock bubble bursts, I think you'll find that everybody who's in Bitcoin, and this has incidentally been hastened by the new ETFs, Bitcoin ETFs, which allows hedge funds and managed funds, if you like, to speculate in Bitcoin, whereas before they had difficulty persuading their compliance officers that this was a good idea. Now, of course, they're listed. You can go in and you can buy the things, you can punt away. And my goodness, look at the volatility. Isn't it wonderful? I mean, if you look at it, it's just shot up from something like 200 in recent months on this scale up to close to 350. I mean, that's a tremendous move. Wonderful stuff. And if you can leverage it, so much the better. But all these bubbles do come to an end. And what this chart is telling us quite clearly is that Bitcoin is a tech bubble. It's as simple as that.
In the aftermath of the banking system's tremors, a pivotal moment unfolds as the government's response to the crisis takes center stage. This response not only seeks to restore faith in a shaken financial system, but also subtly underscores the growing allure of silver as a safe haven for investors navigating these troubled waters. President Biden's assurance of the banking system's solidity in the face of collapse was a beacon of hope for many. By promising decisive action to prevent further bank runs, the administration aimed to shore up confidence among the public and investors alike. The government's commitment to safeguarding deposits, even exceeding the traditional FDIC-insured limit, marked a significant intervention in the financial landscape. This move, while providing immediate relief, also sparked a broader contemplation among investors about the nature of safety and security within the traditional banking system. The realization that banks, long perceived as stalwarts of stability, could so quickly become mired in crisis has led many to reevaluate the composition of their investment portfolios. Against this backdrop, silver's appeal has been magnified. The metal's intrinsic value, untethered from the promises of institutions or the whims of electronic ledgers, offers a tangible sense of security in an era of digital vulnerabilities and systemic financial risks. In contrast to the abstract nature of bank deposits, which recent events have shown can be subject to sudden and catastrophic risks, silver provides a physical, immutable asset that can be held outside the traditional banking system. Moreover, the government's intervention in the banking crisis has ignited discussions about the sustainability of such measures. As investors ponder the long-term implications of government bailouts and guarantees, the question of fiscal responsibility and the potential for inflationary pressures looms large. Herein lies another facet of silver's allure: its historic role as a hedge against inflation. In times when the value of fiat currencies is threatened by government actions, precious metals like silver stand as bastions of value preservation. The unfolding government response has inadvertently cast a spotlight on the broader implications for fiscal policy and monetary stability. As the dust settles on the immediate crisis, the conversation shifts towards the future of financial security and the role of tangible assets in safeguarding wealth. Silver, with its enduring value and historical significance, emerges as a key player in this narrative. As we traverse this chapter of silver's ascendant journey, the government's response to the banking crisis serves not only as a case study in crisis management, but also as a catalyst for a deeper appreciation of the timeless virtues of silver. Investors, now more than ever, are reminded of the importance of diversification, tangible assets, and the wisdom of seeking refuge in the enduring value of precious metals. This reflection on the government's role in stabilizing the financial system underscores a pivotal moment in our collective journey through economic uncertainty. As we continue to explore the multifaceted allure of silver,
I would be very, very
surprised if
the U.S. economy doesn't actually go into a deep slump. So what does that do to the borrowing requirement? We're looking not at 3 trillion, but we're probably looking at somewhere 4.5 trillion. And then you look at interest rates. Are interest rates going to go down when all this funding's got to happen? No. And not only that, but banks are still running scared of lending to small and medium-sized businesses. And, consequently, if there's a scarcity of credit, what happens? The price of it goes up. I mean, it's a no-brainer. It really is as simple as that. And then today we had the Bank of International Settlements came out with a warning that it looks like inflation is going to be around for a while. They made the point about enormous amount of debt that needs to be funded and all the rest of it. And consequently, they didn't see that interest rates were going to decline in the near future at all. So you can see there's a sort of awakening to this reality. And the interesting thing is that the Keynesians would suggest that, under these circumstances, this is bad for gold because higher interest rates, means there's a cost penalty of holding gold. But that misses the point entirely. The whole point about holding gold is it's real money. Quieten down, Keynesians, please. It's real money, not credit. And you're measuring depreciating credit against real money. It's actually as simple as that. And none of the advisors who have spoken to your customers, clients, whatever, actually, I think, understand this point at all. I mean, they really don't. And the other thing is that these people are sort of thinking that gold as a pet rock. It's all, that was all yesterday's stuff. And because, this is propaganda which has been put out since 1971 to try and establish the dollar's position as the reserve currency par excellence. And so now, there is a sort of growing realization, and has been for a few years, that, the current fiat currency situation allows governments to print like Bullion. Bitcoin came along, and that's now meant to be the alternative.
As we delve deeper into the narrative of silver's ascent, attention shifts towards the strategies investors
Bitcoin,
might adopt to navigate this evolving landscape. The recent turmoil within the banking sector, juxtaposed against the government's interventions, has not only heightened the appeal of silver, but also necessitated a nuanced approach to investment. This chapter explores the tactical considerations that underpin a robust investment strategy in silver, balancing the pursuit of opportunity with the imperative of risk management. In the current climate, where the echoes of banking crisis linger and the specter of inflation looms, the allure of silver as both a hedge and an opportunity is unmistakable. However, the path to leveraging silver's potential is fraught with both promise and peril. Investors are thus advised to tread with caution, armed with a strategy that respects the metal's dual nature as an industrial commodity and a precious investment asset. Strategic entry points. Given silver's recent performance and technical indicators, investors might consider several approaches to entering the market. One strategy involves buying on dips or pullbacks towards support levels, such as the notable $23.50 mark. This approach aims to capitalize on temporary retracements in price, offering a favorable risk-reward ratio. Alternatively, investors could look for a breakout above key resistance levels, such as $24.42, as an indication of sustained bullish momentum. Such a breakout could signal the market's confidence in silver's upward trajectory, presenting a timely opportunity for entry. Risk management techniques. Critical to any investment strategy is the implementation of effective risk management techniques. For silver investors, this could involve setting tight stop-loss orders to protect against unforeseen market reversals. A stop-loss order, strategically placed below entry points or key support levels, can help mitigate losses, ensuring that investors are not unduly exposed to volatile swings in the market. Additionally, the use of trailing stop-losses can allow investors to secure profits while giving the position room to grow, capturing the upside potential without risking the entirety of the accrued gains. The role of diversification. In the context of broader investment portfolios, silver's role should be considered within the principle of diversification. While the metal offers a compelling case for inclusion, especially in times of financial uncertainty, it should complement, rather than dominate, an investor's asset allocation. Diversification across asset classes, including equities, bonds, and other commodities, helps spread risk and can enhance the resilience of portfolios to market shocks. Long-term perspective. Investing in silver, especially in the current economic climate, demands a long-term perspective. The metal's intrinsic value, underpinned by industrial demand and its status as a monetary metal, provides a strong foundation for growth. However, market conditions can fluctuate widely in the short term, influenced by geopolitical events, shifts in industrial demand, and changes in investor sentiment. A long-term outlook enables investors to weather short-term volatility and align their investment with the fundamental drivers of silver's value. As we chart the course through the complexities of the silver market, these strategic considerations offer a roadmap for investors seeking to navigate the challenges and opportunities ahead. The journey is marked by uncertainty, but for those equipped with a thoughtful strategy, the potential rewards of investing in silver are within reach. Let us proceed with caution, but also with the conviction that in the pursuit of stability and growth, silver remains a luminous path forward.
Yeah, that's a very sensible question, because we value everything in credit. Credit has become detached from gold, so you can't say that there's a gold standard by which you can measure the value of your property or your your bonds or whatever. If credit becomes valueless, then there is absolutely no basis for valuing property, for valuing credit itself, because the other side of credit is debt. Issued debt, you've got someone has an obligation to pay you something in the future. and under whatever terms, if that goes valueless, then you've lost everything. And that is the bulk. Actually, if you look at financial investments, we're looking around the world at about 150 trillion equivalent. That's the estimate that I've seen anyway. And that would be substantially wiped out. I don't think that credit will go down to zero. I don't see that. But what I do see is I see credit falling very, very hard. The speed of it could be surprising, but we wait to see how events turn out. But I think you'll still be able to use credit as a means of exchange, and by credit I mean currency. And I would guess also bank deposits. So you'll be able to do bank transfers. Why? Because it is a primary function of a central bank to ensure that commercial banks don't go bust. So they are fully aware that if people can't trust deposit accounts or deposits at the banks, then the whole system basically blows up. So they will rescue everything, so the cost of it all goes on to the currency. And it's, in Venezuela, I can't remember what the currency is, but in spite of the fact that it takes a wheelbarrow to buy a loaf of bread or something, it's still being used, as far as I can see. They are using other currencies. I guess the dollar is probably used a lot, rather like it has been in Argentina.
As we journey through the landscape of silver's rising prominence, we arrive at a pivotal moment that encapsulates both the historical context and the forward-looking perspective of precious metals investing. In this chapter, we delve into the broader precious metals market, with a particular focus on gold's recent achievements and the anticipated bull market in precious metals, fueled by a confluence of economic indicators and geopolitical tensions. Gold, often heralded as the standard-bearer of precious metals, has recently achieved a new milestone, breaking above the significant $2,100 resistance level. This achievement is not just a testament to gold's enduring appeal, but also signals a broader shift in investor sentiment towards precious metals. The breaking of this resistance level suggests that gold may have established a new support level, providing a foundation for an extended bull market in precious metals. This development is particularly noteworthy as it occurs amidst a backdrop of heightened global uncertainty, inflationary pressures, and shifts in monetary policy. The anticipated bull market in precious metals, encompassing both gold and silver, is underpinned by several key factors. Central bank buying, especially in countries seeking to diversify their reserves away from the US dollar, has emerged as a significant driver. This strategic shift underscores a broader recognition of gold and silver's role as stores of value in an era of currency debasement and fiscal profligacy. Moreover, the demand for precious metals from Asia, particularly China and India, continues to exert a considerable influence on the market. These countries have a deep cultural affinity for gold and silver, viewing them not just as investment vehicles but as integral components of social and religious traditions. The robust demand from these markets, especially during festive and wedding seasons, adds a layer of support to precious metals prices. Another critical factor shaping the precious metals market is the weakening of the US dollar against a basket of other currencies. As the dollar experiences volatility, partly due to the rapid increase in outstanding treasury debt, investors globally are prompted to seek refuge in assets that have historically preserved value across economic cycles. The intrinsic value of precious metals, untethered from the promises of any single government or financial institution, becomes increasingly appealing. This burgeoning bull market in precious metals is further fueled by the broader economic and geopolitical landscape. Concerns over inflation, which erodes the purchasing power of fiat currencies, combined with geopolitical tensions and economic uncertainties, drive investors towards safe haven assets. Precious metals, with their historical resilience in times of turmoil, stand out as beacons of stability. As we consider the future of precious metals investing, it's clear that the interplay of economic indicators, geopolitical dynamics, and shifts in monetary policy will continue to shape the landscape. The journey of silver, alongside gold, in this emerging bull market is emblematic of a deeper search for stability, value, and security in an increasingly uncertain world. In the unfolding story of silver's ascent and the broader narrative of precious metals investing, we are reminded of the cyclical nature of markets and the timeless appeal of assets that have served as pillars of wealth preservation through the ages. As we navigate the complexities of the present, the precious metals market stands as a testament to the enduring quest for assets that transcend the vicissitudes of economies and empires.
Yeah, when you told me that, I was actually quite amused in a sense, because they're obviously just working off the charts. I mean, they haven't got a clue what they're talking about, which should be no surprise to us. It's been a fascinating market because what's driven it to new high levels is really central bank buying, demand from the Far East. I mean, China. Bear in mind that the Indian economy has been growing at an enormous clip, and of course, is creating, ultra high net worth individuals. Now, do they import their gold into India? No, they managed to get resources outside India, outside any exchange controls. And I should think they're probably stashing their gold in places like Switzerland and maybe Singapore. The demand from Asia is only just really starting. And also driving the price is the weakness of the dollar. We're suddenly beginning to realize that the dollar has got a debt problem. We've seen, goodness knows how many people remarking that in the last 100 days, outstanding Treasury debt has increased by a complete $1 trillion. And people are beginning to realize that in this current financial year, you're probably looking at $3 trillion of new stock, plus about, I think it's 7.6 trillion of refinancing. Now, who's going to buy it? This is a problem. And of course, we've been talking about this for some time, but you can see how it's a situation which leads to loss of credibility in a fiat currency. It's actually as simple as that. It's not so much gold rising, it's the dollar going down. Now, most people would think, well, the dollar is actually pretty steady. The trade weighted is 103.4 or 6 or whatever it is. But we're not talking about the dollar against other fiat currencies. I mean, it is the king of fiat currencies. We're talking about the complete fiat currency cohort meeting a problem. Now, that 3 trillion of borrowing in this current fiscal year, which takes us up to September, assumes that the US economy isn't going to slip into recession. Well, I tell you, it's already in recession. The only reason that the GDP numbers look good is because of the money printing or the credit printing by the Fed. Well, yeah, by the Fed, if you like, and the US Treasury. The US Treasury is spending this money into GDP. It's not productive. So the idea that the economy is looking good is not at all true. It's a fascinating thing because I think the prospects are extremely good. They are so out of fashion to be ridiculous. I mean, we have gold. We've had gold sort of knocking on the 2,000 level, and now that's certainly support, and arguably even 2,100 is now support. And what's gold? What have gold mines done? Very, very little. I mean, the HUI index, I see it here as 220, having been down to something like 198. I mean, okay, it's up 4.5% today, but this is it is crazy. In terms of stock market valuations, of course, all the fashion is with the tech stocks. And the result is that mining stocks are just completely ignored. Not only that, but they have been out of favor for so long that mainstream investment managers actually haven't got a clue how to value them. So they really are lagging behind the curve. And my personal view is that it'd be worthwhile looking at, the sort of, if you like, the majors. I mean, just go for safety. You don't need to be terribly clever. Don't start going for 10 baggers and 20 baggers, which, if you're going to play that game, you have got to know a lot about geology. You've also got to know the management. You have got to have been moving in those circles for some time. You've got to be someone like Rick Rule to do that successfully. Otherwise, there is a big risk you come a cropper. So just go for the majors. And I think I would say that they look terribly
In this penultimate chapter of our exploration into silver's ascent and the burgeoning bull market in precious metals, we pivot to a broader examination of the systemic challenges facing the global financial system. These challenges, encompassing fiscal profligacy, monetary expansion, and the erosion of trust in traditional financial institutions, underscore the strategic shift towards tangible assets like silver. The global financial landscape is marked by a proliferation of debt, a phenomenon that has escalated in recent years due to expansive fiscal and monetary policies implemented by governments and central banks worldwide. This debt accumulation, particularly in developed economies, raises profound questions about the sustainability of current financial practices. As nations grapple with ballooning budget deficits and an ever-expanding monetary base, the potential for a significant devaluation of fiat currencies looms large, igniting concerns over inflation and the erosion of purchasing power. Alisdair Macleod's critique of the Keynesian economic model, which advocates for increased government spending as a means to stimulate demand and economic growth, offers a compelling lens through which to view the current predicament. The Keynesian approach, while popular among certain economic circles, is increasingly scrutinized for its long-term implications, including the risk of hyperinflation and the potential for economic stagnation. In this context, the shift towards tangible assets, particularly precious metals like silver and gold, can be seen as a rational response to the uncertainties of the fiat currency system. Precious metals, with their finite supply and intrinsic value, offer a stark contrast to fiat currencies, which can be printed ad infinitum, leading to depreciation over time. The role of precious metals as safe haven assets is further reinforced by their historical performance during times of economic turmoil. Unlike stocks, bonds, and other financial instruments, precious metals are not reliant on the performance of any single economy or corporation. Their value is recognized globally, transcending borders and financial systems, making them an attractive option for investors seeking to diversify their portfolios and protect their wealth from systemic risks. Moreover, the rise of digital currencies and blockchain technology has introduced new dynamics into the conversation about money, value, and trust in financial systems. While cryptocurrencies offer innovative approaches to finance and the potential for decentralized control, they also introduce volatility and regulatory uncertainties. In contrast, precious metals like silver provide a tangible, time-tested store of value, offering stability amidst the digital transformation of finance. As we approach the culmination of our journey through the world of precious metals investing, it's evident that the challenges facing the global financial system are complex and multifaceted. The resurgence of interest in silver and gold is not merely a speculative trend, but a strategic move by investors who recognize the fundamental shifts occurring in the economic and monetary landscape. In a world marked by uncertainty, the allure of precious metals reflects a deeper search for security, stability, and value preservation.
Well, I'm very sorry about that. I don't actually remember saying that, but if I did, then I did. Silver basically, once gold starts running, you'll find that silver runs approximately twice as fast. The problem with silver is that when gold is not running, gold can be moving sideways, then the price can decline. And we've seen this. We saw silver running back down to 22, 21 something, having been up to 26 when gold first hit that high at 2070 in August 2020. It's a difficult one. I think the problem also with silver is that no central bank regards silver as a monetary metal for the purposes of its reserves. It is an industrial metal. Now, I would argue that as an industrial metal, it's actually got enormous qualities. And on that basis, I would think that the price here is too low. But the relationship in the paper markets is quite simple. When gold starts running higher, silver runs almost twice as fast on average. So now that we see that gold is breaking out into the upside, we're talking about the price of it in dollars, then on that basis, I think we could well see that silver might catch up and run back up to that $26 level. So hopefully you'll feel a little bit more wealthy as a... No. I don't think there's any point in elaborating on it. I mean, emotionally, I can understand. I take the point, but I mean, no. I mean, not only that, but if J.P. Morgan's bullion dealing desk was caught out and charged with spoofing fraud, and senior executives actually went to jail on it. And J.P. Morgan were fined quite heavily. I mean, certainly heavily in our terms. But actually, I don't think there's a cat in hell's chance of anyone, successfully suing them. I mean, you could sort of go to Texas, where they historically have been quite prepared to entertain this sort of thing. But would you ever collect? No, I don't think so.
As we reach the apex of our exploration into silver's dramatic rise and the broader context of financial uncertainty and systemic challenges, it's imperative to distill the essence of our journey and articulate a forward-looking perspective. This concluding chapter synthesizes the insights gleaned from the evolving dynamics of the precious metals market, the vulnerabilities of the banking system, and the macroeconomic undercurrents shaping investment strategies today. The narrative of silver, set against the backdrop of economic turbulence and fiscal irresponsibility, has emerged as a compelling testament to the metal's enduring value and appeal. Amidst the cacophony of market speculation, geopolitical tensions, and the erosion of trust in fiat currencies, silver stands as a beacon of stability, offering both sanctuary and opportunity to those navigating the treacherous waters of the global financial system. The case for stockpiling silver, as articulated by analysts like Alisdair Macleod, is anchored in a confluence of factors that transcend mere speculation. The burgeoning debt levels, rampant monetary expansion, and the specter of inflation point to a future where the sanctity of traditional financial instruments and currencies is increasingly questioned. In this environment, silver, with its intrinsic value, limited supply, and diverse industrial applications, emerges not just as a hedge against economic uncertainty, but as a prudent investment for wealth preservation. The anticipated surge in silver prices to unprecedented levels, as posited by Macleod, is underpinned by sound logic and a deep understanding of the market's fundamentals. The increasing demand for silver in industrial applications, coupled with its role as a monetary metal, positions it uniquely within the precious metals market. As investors seek refuge from the volatility of fiat currencies and the vagaries of the stock market, silver's allure is magnified, presenting a compelling case for its inclusion in investment portfolios. Moreover, the strategic acquisition of silver, especially in the current economic climate, speaks to a broader recognition of the need for tangible assets that can withstand the tests of time and economic cycles. The wisdom of diversifying one's investment portfolio, not just across asset classes, but into assets that offer a bulwark against inflation and financial instability, has never been more pertinent. In conclusion, the journey through silver's ascendance and the exploration of the forces shaping the precious metals market illuminates a path forward for investors. In a world brimming with uncertainty, where the constructs of wealth and value are continually evolving, silver offers a tangible connection to stability and security. As we navigate the future, the lessons gleaned from this exploration underscore the importance of vigilance, strategic diversification, and the recognition of silver's unique position within the pantheon of investment options. As we draw this narrative to a close, let us carry forward the insights and understandings that have emerged, leveraging them to make informed decisions in our pursuit of financial security and prosperity. The story of silver, reflective of broader economic and financial themes, continues to evolve, inviting us to remain engaged, curious, and prudent in our investment choices.
What the GDP is basically the sum total of transactions in qualifying items. So, buying cars, buying, food, buying electronic goods, buying clothes, buying, all the normal stuff, if you like, which is in GDP. What the GDP measure is, it's the sum total of all those transactions. And it's seen by economists, if you like, as a measure of economic activity. This is actually incorrect. What it really does measure is the government's tax base. And that's why governments actually like it, because it's on the basis of these transactions that sales taxes can be levied. Income is another way, if you like, consumer income is one of the ways in which GDP is calculated. So that also gives you an indication of income tax, and also corporate tax on Main Street, and so on and so forth. So it's a very, very good indicator for governments of tax. But what it does not tell you is the quality of goods being bought and sold with that credit. And so that's the way to look at it. That is why it's an entirely false figure. We shouldn't be looking at it in terms of, this is an indication of economic activity, because, the economy can be going to hell in a handcart, and GDP is still rising because the government is spending into, it's in effect, it's debasing the currency and juicing up the numbers as a consequence. That's really what happens. And I first noticed this many, many years ago. We had a chancellor called Gordon Brown, who subsequently became prime minister. When he was chancellor, he continually surprised the markets with the behavior of GDP, which was always slightly better than markets expected. But actually, when you looked at it, and I worked this one out, and nobody else seemed to be paying attention, it was quite simple. That extra performance was as a result of extra government spending. So, that's what it's about.